Okay, we're now going to take a look at exercise 13.4, which deals with employees earning vacation pay. Now the rule on that, you guys, we want to record it as wages expense in the year the employee earns the vacation if they're going to take it in a future year. So let's say they earn the vacation pay in 2016, but they're not going to take the vacation until 2017. Then we want to take the wages expense associated with the vacation in the year it was earned by the employee, 2016, not the year it was taken, 2017. We do that as long as the employee is entitled to the pay even if they're fired or quit. Okay, so, or retire. If they retire and we have to pay them for the absences, or we have to pay them, pay them for the vacation pay when they retire, or when they're quit, or when they're fired, then we want to go ahead and record the wages expense associated with that vacation pay in the fiscal year that the employee earned the vacation, not in the year they take it. Now those could be one and the same, and we have some of that in this problem. Let's read through it. JWS Transport Company's employees earn vacation time at the rate of 1 hour per 40-hour work period. Okay, so they want to earn 1 hour of vacation for every 40 hours that they work. The vacation pay vests immediately, meaning they're entitled to take it as soon as they've earned it. And that goes on to say that is, an employee is entitled to the pay even if employment terminates. Now, a lot of places you'd have to work there so many years for that to be the case. Not the case, though, here at JWS Transport Company. During 2016, total wages paid to employees equaled $404,000, including $4,000 for vacations actually taken in 2016, but not including vacations related to 2016 that will be taken in 2017. So what they're saying, that $404,000 includes some vacation taken in 2016 that was also earned in 2016. So the first thing we want to do here is calculate the amount of non-vacation wages. Well, total wages expense for the year was $404,000. Minus $4,000 of that was for vacation earned in 2016 and taken in 2016. So let's subtract out that $4,000. So our non-vacation wages for 2016 were $400,000. So let's see the total amount of vacation pay earned in 2016 by the employees. Well, that's going to be your $400,000 from above. That's K5, I believe. Times 1 over 40. So we have $10,000 of vacation pay earned in 2016. All right, we want to subtract out the vacation pay earned and taken in 2016. That was $4,000, as we've already seen. And that'll get us the amount that's going to carry over to the next year. So we've got $10,000 of vacation pay earned by employees in 2016. I hope that made sense. It's 1/40th of the wages expense. Think about it. If they're earning 1 hour of vacation pay for every 40 hours worked. Well, if they were making $1 an hour, right, then they'd earn $1 of pay, vacation pay, for every 40 hours worked. So that 1/40th times the 400,000 works to get us this $10,000 number. Okay, now we're going to take that vacation pay earned in 2016 and subtract the vacation pay earned and taken in 2016, which was $4,000. That gets us the amount of vacation pay carryover. It's earned in 2016. It will be taken in 2017 or sometime later. So that's the amount for our adjusting entry here on December 31st. We're going to debit wages expense. which brings its total from $404,000 up to $410,000. The non-vacation wages plus the vacation pay earned in 2016. So we're going to debit wages expense for the $6,000. Vacation carryover. Alright, and that creates a liability for the company. We're going to call that liability compensated future absences. Now, the name of that account, you could just call it vacation payable. You know, the name here would just depend on what the company decided to call it. But of course, it would be a liability. And it is associated with compensated future absences. And we credit that account to increase the liability for $6,000. Okay, now if the employee had earned the vacation in 2016 and taken it in 2016, this $4,000, during the year we would have debited wages expense for that amount, and the credit would have been to cash just like we had paid them, right? Because they would have gotten paid even though they weren't at work. Now, in 2017, let's say employees take this entire $6,000 worth of vacation pay. Then the period in which they take it, we would debit this liability account, and the credit would be to cash because we're paying them for those days off. Okay, I hope that makes sense. What we did over here was calculate the amount of non-vacation wages. Well, the total wages were $404,000, but for vacations earned and taken in 2016 were $4,000. So we subtracted the $4,000 from the $404,000 to get the $400,000. To get vacation pay earned in 2016, we just said the $400,000 times 1/40th, because they earn vacation at the rate of 1 hour for every 40 worked. Alright, then we subtract out the vacation pay earned and taken in 2016, which was $4,000. That gets us the amount that's going to carry over to 2017, $6,000. A debit to wages expense in the adjusting entry to end of 2016, and a credit to a liability account. They called it liability compensated future absences. You could call it vacation payable. That just depends on the company what they would name it. Okay, after working that one with me, I don't think you'll have any trouble with the homework problem. It's exercise 13.4, of course, in the Connect Plus site. If you have questions, please be in touch. Thanks.